What if I told you that the biggest stock market crash in over a decade could be just weeks away, not months, weeks? And right now, most Americans have no idea what's coming. Stay with me, because by the end of this video, you'll know exactly what the warning signs are, what Wall Street insiders are quietly doing with their money, and what you can do right now before it's too late. Welcome back to Finzora News, your home for daily U.S. financial updates. If you're new here, hit that subscribe button right now, because what we're about to break down today could be one of the most important things you watch all year. Here's what just happened. In the last few weeks, some of the world's most respected investors, economists, and financial analysts have started using a word that makes Wall Street nervous: crash. Not a correction, not a pullback, a crash. We're talking about a potential 40 to 50% drop in stock market value. That means if you have $100,000 invested today, you could be looking at $50,000 or less if this plays out the way some experts fear. And here's the thing: the signs have been building for months, but most people either missed them or chose to look away. Let's break this down from the beginning so everyone watching, whether you're a first time investor or someone who's been in the market for years, can fully understand what's happening and why it matters to you personally. The stock market, at its core, is a reflection of how confident people are about the future of the economy. When businesses are growing, when people have jobs, when interest rates are low, and when money is easy to borrow, stocks go up. But when those conditions reverse, the market doesn't just slow down, it can collapse fast. And right now, multiple conditions are reversing at the same time. Think about interest rates first. The Federal Reserve, which is basically the central bank of the United States and the most powerful financial institution in the country, spent the last couple of years raising interest rates aggressively to fight inflation. Inflation, in simple terms, is when the prices of everyday things like groceries, gas, and rent go up faster than your paycheck does. To slow that down, the Fed makes borrowing money more expensive. That sounds like a technical fix, but here's what it really means for regular people and for the stock market. When borrowing becomes expensive, companies can't grow as easily. They can't take out cheap loans to hire more people, build new factories, or develop new products. Their profits start to shrink. And when profits shrink, stock prices fall. Now multiply that across thousands of companies, and you start to understand why higher interest rates are like slow poison for a bull market. But that's not all. Here's where it gets serious. Despite the Fed's efforts, inflation is proving stubborn. It's not dropping as fast as officials had hoped. That means the Fed may have no choice but to keep interest rates higher for longer than the market expected, and the market hates uncertainty. Every time investors sense that rate cuts are getting delayed, they panic, and that panic shows up as big red days on your stock portfolio. Now let's talk about something that doesn't get nearly enough attention in mainstream media: corporate earnings. Over the last 2 quarters, some of America's biggest companies have started quietly warning investors that future profits may disappoint. These are household names, companies whose products you use every single day. When they start lowering their own expectations, that's not just a red flag, that's a siren, because stock prices aren't just based on what a company earned yesterday. They're based on what investors believe the company will earn tomorrow. When tomorrow starts looking worse, stocks get repriced lower and sometimes very quickly. Here's a real-world way to think about it. Imagine you buy a rental property expecting it to bring in $2,000 a month. That's why you paid the price you did. Now your tenant tells you they can only afford $1,000 a month going forward. Suddenly, that property isn't worth what you paid for it. Stocks work exactly the same way. When the expected future income drops, the value of the stock drops with it. This could directly impact millions of Americans, especially the roughly 60% of U.S. adults who have money in the stock market through retirement accounts like 401ks and IRAs. This isn't just about traders on Wall Street. This is about your retirement, your kids' college fund, your financial future. And now, here's something that most financial news channels won't tell you plainly. The market has been artificially propped up for a long time. After the COVID crash in 2020, the government pumped trillions of dollars into the economy through stimulus checks, business loans, and bond purchases. That flood of money pushed stock prices to historic highs. But that artificial fuel is now gone, and what goes up on borrowed energy has to come back down to reality. Here's what just happened in the bond market, and pay close attention because this is one of the clearest warning signs experts are watching right now. U.S. Treasury bond yields have been surging. Now, if that sounds confusing, here's the simple version. When bond yields go up, it means investors can earn more money from safe government bonds without taking any risk at all. So, why would they keep their money in risky stocks? The answer is many of them won't. And when big institutional investors, the pension funds, the hedge funds, the insurance companies, start rotating money out of stocks and into bonds, stock prices fall, sometimes sharply. We're already seeing early signs of this rotation happening, and historically, every time this pattern has emerged at this scale, a significant market downturn has followed within 6 to 12 months. Some analysts believe we're already in that window right now, but that's not all. Let's zoom out even further. The global picture is adding more pressure. China's economy, which is the second largest in the world, is slowing down significantly. Europe is flirting with recession, and geopolitical tensions from ongoing conflicts to trade disputes are creating uncertainty that markets despise. The U.S. economy doesn't exist in a bubble. When the world slows down, American companies that sell products globally feel that pain in their revenues, and investors feel it in their portfolios. Now, here's the question everyone wants answered. Is this crash actually going to happen? And when? The honest answer is that nobody can predict the exact moment a crash begins. Not the Fed, not Goldman Sachs, not even Warren Buffett. But here's what we do know. The conditions that have historically preceded major market crashes are all present right now. High valuations, rising rates, slowing earnings, global economic stress, and a retail investor base that is largely unprepared. The legendary investor Warren Buffett has a famous saying, "Be fearful when others are greedy, and be greedy when others are fearful." Right now, by several measures, the market is still in greedy territory, and that's exactly the kind of environment where crashes are born. So, what should you actually do? First, don't panic. Panic selling at the wrong time can lock in losses and keep you out of the recovery that always follows a crash. History shows that the U.S. market has recovered from every single downturn, including the Great Depression, the 2008 financial crisis, and the COVID crash. But the people who got destroyed were the ones who made emotional decisions at the worst possible time. That said, smart investors right now are reviewing their portfolio risk. If you're heavily concentrated in high growth tech stocks or speculative assets, this might be a moment to assess your exposure. Diversification, spreading your investments across different asset classes like bonds, dividend stocks, real estate, and even cash, can act as a cushion when volatility hits. If you're closer to retirement, the stakes are even higher. A 40 to 50% crash means you'd need a 67 to 100% gain just to get back to where you were. That's years of recovery time that people approaching retirement simply don't have. Speaking to a certified financial advisor right now, not after the crash, but right now, could be one of the best financial decisions you make this year. Here's the bottom line: whether this crash comes in 3 months or 12, the warning signs are too serious to ignore. The investors who will come out ahead are the ones who stayed informed, stayed calm, and had a plan ready before the storm hit. That's exactly why Finzora News exists, to give you the information you need, in plain English, before it's too late to act. If this video helped you understand what's happening in the market right now, please give it a thumbs up. It takes 2 seconds, and it helps us reach more Americans who need this information. Subscribe to Finzora News and hit the bell icon so you never miss a daily financial update. Share this video with someone you care about, because in times like these, staying informed is the most powerful financial tool you have. We'll see you in the next one. Stay sharp, stay safe, and stay ahead with Finzora News.